Yeah, you're listening to the Money Talks program here at 2RRR 88.5 FM. I'm Dave Hazeldine, and in the studio with me this afternoon I've got Dr. Mark Dussault, who's the Exponential Growth Strategist.
I know, it's a mouthful.
So we haven't had you on the show, we're just trying to figure it out for maybe 12 months.
Oh, I don't know if it's been that long. It seems like just yesterday, and then it seems like a long time, yeah.
All in the same breath, yeah.
That's right.
So tell me, just for people who haven't heard of you, and what is an exponential growth strategist?
Well, basically, I help people grow their businesses exponentially. What that means is that I help them double or triple their sales in 12 to 24 months.
Yep.
But today, what I want to talk about is, once you acquire that kind of wealth, what do you do with it? So I thought, Money Talks program, I've been on the show a few times, and we always have a good time. I figured, why not talk about alternative investments that create extraordinary returns while you're having fun. So I figured, we go out left field a little bit, because I know you like to go out left field and have a counterintuitive approach. So
every now and again,
figured we'd have some fun today.
Within reason, yeah. Very good. So when you're talking alternative investments, you're talking directly held investments. We're talking
about anything that's not the property market or stocks, basically. So anything that's not those two things would be, to me, in the category of alternative investments.
So, give us a couple of examples.
Rare coins, gold bullion, silver, art, jewelry, pink diamonds, things like that.
Now, this is where I've got to declare my hand, because...
Of course.
Because...
I would expect nothing less.
Because and gold and things like that aren't what I would call part of somebody's core portfolio.
Correct. Because that's why these are alternative. These are not core investments.
Because I have no trouble, or with a lot of work, I can value a company. I can put my valuation on it. The problem I have with things like gold and art and coins is that their value is so much subject to fashion and flights of fancy almost.
Yeah, that's a misperception. That's really a misconception of the actual alternative investment field. Yes, there are things that, whether the Beatles are popular or Michael Jackson passes away, that's going to have an impact on certain categories of collectibles. But if you look at it from a genre, comic books are the same thing. But if you look at the genre of alternative investments, they outperform the stock market and the property market by orders of magnitude. And they have been since 1949, 1950.
Wow, I'm really surprised by that, and I'd like to get into that.
Yeah, because it can go to 15 to, in some cases, 30%. But let's not exaggerate. Let's say it's 15%. So that's better than the stock market will give you, and it's definitely better than the property market.
Yeah. Okay. I'd like to.
But I'm not advocating that this is a passive income strategy, because it's not.
Yeah.
And I'm not advocating that this is a core strategy either. This is, when you have a portfolio, you want to pick anywhere between 10 to 20, maybe 25%, but definitely not more than 25%. So, different experts have different perceptions. And again, it's a question of whether or not you include money in there. In other words, currency or foreign exchange.
Yep.
I exclude foreign exchange or currency or holding money and playing, the change in currencies.
Yeah.
So I would say the maximum would be 15% of your portfolio. And to be safe, you just stick with 10%.
Yeah.
But that 10% can outperform the rest of your portfolio if you know what you're doing. And that's why I thought to bring this to people's mind. If you start thinking about it now, in a couple of years from now, you may actually be a very good alternative investor.
Yeah. Is it a case of, this is again what I get back to in this program all the time, is learning to crawl before you walk.
Well, actually, what I focus on in business is the same thing. It's called Antiemetic isomorphism, and I know you still have trouble with that.
Yeah.
Antiemetic isomorphism basically means having fun, doing out-of-the-ordinary things that create extraordinary results with the least amount of effort and lowest cost. So if I just dissect that, it's basically doing things that are different than the norm. In other words, if there's the herd, you go against the herd. And if it's an alternative investment, again, with 10% of your portfolio, that 10%, if you know what you're doing, you can actually outperform a large portion of the rest of your portfolio. And I'm not talking about taking risks. And the having fun part is critical. So if you're into comic books, for example, I know someone who collected comic books for fun, and 10 years later ended up with a $35,000, $40,000 collection. Now that was about 20 years ago. So today that would be worth about $150,000. Now imagine you have a hobby that ends up with $150,000 of capital growth Now, granted, you might have spent $5,000 or $10,000, maybe even $20,000 buying those comic books, but you're getting the enjoyment out of it. And in the end, you actually have capital growth. If you go fishing, you buy your boat, you go fishing, 5 years later, what do you have? You have a boat payment.
That's about it, yeah.
Right, and that's about it. So if you have fun and you have different pastimes, you can actually turn those into something that can actually create a lot of wealth. And again, it's not a question of doing this as a task or as a job, it's literally having fun and just adding it into the mix. So then you have more fun investing, and guess what? Maybe your other investments will do a little bit better just because you're having fun doing it.
I was just going to say that anything that gets people involved
Correct.
with taking control of their financial future has got to be a good thing.
Yep.
Australians generally suffer from this apathy in relation to their financial future. In almost it'll look after itself.
Correct. It's because it's in 20 years from now. You know, in 20 years from now, I'll deal with it, or I'll deal with it in 15 years. Well, guess what? That day never comes. And like you said, if you walk before you run, especially if you're having fun, one of the best things people can do is buy coins for their children when they're very young. One, it's because it's money, but second is because it usually appreciates.
Yep.
So if you get $1 or a 20-cent piece, or whatever it might be, and all of a sudden it's worth $4 or $5, all of a sudden you look at it 10, 15 years later, you go, what's this in the drawer? Now you realize, wow, this is appreciated. That in itself is a lesson. And even though it's not income generating, because I know one of the primary things that you talk about is passive income, which I'm a big proponent of, because you got to pay the rent, and I totally get that. But again, if you can create capital growth, and then when you actually want to retire, start selling some of those assets, that actually can create income for you on an ongoing basis.
Yeah, this is where I get a little bit, maybe a little bit misunderstood in that I look for total returns.
Sure.
You really only break up income and capital growth for tax purposes.
Yeah.
So if you've got something growing at 20% and not necessarily paying you an income, it's still an asset there that you can turn into cash at some point in time and therefore spend.
Yeah, taxation is a big distortion of wealth creation. It's been written up in academic journals that because people have such a focus on tax, they don't realize that they should be thinking about wealth creation, like you said, as a holistic perspective. And what I want to talk about today is to focus on the fun part, because if you can do that, then the rest basically follows.
And to set the framework, in Australia, it's actually far more tax efficient to have capital gains than it is
Sure.
to have income.
Absolutely.
So
In most tax jurisdictions, that's the case. But what people don't like is to wait and wait and wait for that payoff. What they want is they want the income, and then they don't realize that if you get the income now, you're getting taxed every time that income comes in. So the net effect of the negative compounding, the erosion, the tax erosion of that, even in a super fund that's taxed at a lower rate
that's right.
than a personal individual would be, it's still disastrous.
So yeah, there's a bit of food for thought there, but we might take a break now and come back with more of the Money Talks program and talking to Dr. Mark Dussault in relation to alternative investments.